All right, let's officially get underway with this meet. This is kind of a different kind of meeting. I said to Christian a little earlier, this was designed to be for the active passive working group because this active and passive investing remains a key topic that we're always interested in. Christian submitted a piece in our call for papers contest. It did not turn out to be the winner, but it's still a really, really compelling piece of research. I wanted to invite him here this morning to talk a little bit about it. And then I want to keep this as informal as possible. We could have a presentation.
Come on, come on.
Christian could
Let's
talk
go.
for an hour on this stuff.
Definitely.
So, and hopefully you've got enough slides to do that if the conversation kind of falters. But I shared a bunch of questions with him last night as I went through the piece again. But I just want to tee him up a little bit. Christian Kontz, he'll talk about the real cost of benchmarking. And Christian, correct me if I'm wrong on any of this stuff. Current PhD candidate at Stanford University. You're also a visiting student at the University of Chicago, pre-doctoral fellow at Princeton, and a teaching and research assistant at the University of Hamburg. Earned his master's degree in international trade, finance, and development at the Barcelona School of Economics and a Bachelor of Science in Economics at the University of Hamburg. Did I get all that right?
That's all correct. Thank you, Robert.
Okay, terrific. He's also got a full head of hair, but we won't hold that against him. So, hey, I don't think I did this. Let me see. Do you have slides that you want to share?
Yeah.
Okay. Okay, let me see if I gave you the permissions to do that. And then what I asked Christian to do was just kind of hit the highlights. Everybody had the piece, hopefully had a chance to go through it, but just hit the highlights and then open it up to some questions. And again, as much as we can, have a conversation about this rather than a presentation. But Christian, with all that, thank you so much again for being here. I'll turn it over to you, my friend.
Thank you. Let's just get me settled in here. Okay, can see you on this other screen. And then you should be able to see the slides. Is that right?
Yeah, looks like you're in presentation mode, so we're set.
Okay, sounds good. Yeah, thank you for having me. This is joint work with Sebastian Hansen, who, oh, my screen share is paused. Resume. Why is this not working?
Technology.
Yeah. Well, let's just try to share it again.
Christian, one thing, we had a presenter on a couple weeks ago, and whenever he tried to go into presentation mode, he had some issues. But this looks good now.
Works now, right?
Yes.
Okay, sounds good. Yeah. This is joint work with Sebastian Hansen, who used to be a PhD student at Stanford GSB as well, but now works in industry. And this paper is broadly motivated by this large increase in passive investing that you're all aware of. And or more specifically with benchmark linked investing. And what I plot for you here is the average stocks benchmarking intensity. Benchmarking intensity is really just a measure of ownership share. So when it says 4% down here in the early 2000s, it means that roughly 4% of a stock's market equity were held by benchmark mutual fund and ETFs. So it includes both active as well as passive mutual funds, because they kind of tracks also the quasi-indexing behavior of active fund managers. And as you can see, and I think you're well aware of this, this ownership share, especially among passive funds, has increased quite drastically. Here in the time series from 98 to 2018, it has more than quadrupled. And we know from a lot of research actually already over the past 25 years that the passives inelastic demand affects asset prices. And specifically, there are like two effects that I'm going to talk about today. That is, the first effect is kind of a price effect at index inclusion. Usually when a stock joins a big index like the S&P 500 or transitions between the Russell indices, we see that there's a small price pop at index inclusion. And then after the stock has been included in an index, there is excess co-movement among index stocks. What that just means is that the covariance among index stocks is high. And we argue this has like important implications, especially the second part, because firm managers learn from asset prices, not least because we teach them to do so in our business schools, where we usually teach them in one of the first classes that they should use the capital asset pricing model to discount cash flows that are in the future back to today's value. And what we show in this paper is that with the rise of passive investing over the past 25 years and an increase in benchmarking intensity at the stock level, what has happened is that CAPM betas have increased, and they have increased by quite a bit for most firms. And this has led managers to kind of infer that their cost of equity has increased. And then we see that they have reduced their capital expenditure and increased payouts.
First,
If
can I
there are any
interrupt?
questions or anything is unclear, just jump right in. And
Yeah, perfect. The chart is terrific. It's through 2018. Do you have anything more current, or have you seen anything more current? I'm assuming that trend is continued or even accelerated.
Yeah, probably. Unfortunately, this data we're currently in the work of extending it because we will rely on work by some other academics that created this benchmarking intensity measure, and they unfortunately kind of stopped in 2018. But
Okay.
I'm sure it will have only increased even more.
Okay, thank you.
Okay, with that. So what we do is we kind of start out this paper by documenting like 3 novel facts about the cross-section of benchmark constituent stocks. And then in the most of the rest of the paper is just making sure that these facts that we document are more than correlations, that there is actually some sort of causality behind these facts. But let me go through these facts. So what we document is that stocks that have a higher benchmarking intensity also have higher CAPM betas. So there's a positive correlation between CAPM betas and benchmarking intensity, or the ownership share of benchmark mutual funds and ETFs. And what we then document is that this high ownership share negatively correlates with firm investment and negatively with net equity issuance. So it is the firms that have the highest ownership share of benchmark mutual funds and ETFs, or passive owners, that invest the least and issue the least equity, which from an academic standpoint is a bit puzzling, because there's many academics that would argue that passive investing, is great for firms because now they will they have like all this inelastic demand that comes from passive funds, which now allows you to sell equity to these passive funds, and then you can just use your equity that you sold to these inelastic guys that will buy at any price, basically, to use it for investment. And we show that the story seems to be a little bit incomplete. And what we argue is that what really matters here is that the CAPM betas are much higher in a regime where we see a lot of passive investing. Let me walk you through these slides and these facts. What I plot for you here is on the left-hand side CAPM betas, and on the right-hand side benchmarking intensity. And now I plot them against the market capitalization rank in May. So the first 500 here, the first 5 dots would be the S&P 500. And each dot represents here roughly the equal weighted average of 100 stocks. And the first 10 dots here, these would be the Russell 1000. And you can see here at the 3000 cutoff is the Russell 3000. And as you can see, there's like this is like a negative sloping relationship here, at least in the CAPM betas. And as you can see here on the right-hand graph, you see that, for example, at the 3,000 cutoff, benchmarking intensity or the ownership of passive funds drops off quite drastically because not many funds are benchmarked or are index trackers that track the smaller stocks. These cross-sectional relationships that you see here, I plot them in the early 2000s, which we kind of set as our benchmark period. This is the basically the equilibrium that we were in before the rise of passive investing. And now I want to show you what this relationship looks like today, or like not today, but in the late 2010s, where we've seen a very large increase in benchmarking intensity, especially for small and mid-cap stocks, where we've basically doubled the amount of passive ownership for these stocks. And as you can see, what also seems to have happened here is that the betas have increased, especially for these stocks. And if you stare at this long enough, you notice that there is these breaks kind of in the data that line up very nicely with the Russell 2000 and the Russell 3000 cutoffs for inclusion. So as you can see here, the Russell 2000 stocks, right? They have now much higher CAPM betas. And then a lot of ink is spilled in the paper on like making sure that this correlation that we see here is actually causal. And I'm happy to walk anyone through the details that is interested. Are there any questions to this graph? Otherwise, I'm going to move on. Oh, I want to point out one thing before I forget. From this graph, it almost looks like that all CAPM betas have increased, which obviously can't be the case since the value-weighted CAPM beta needs to equal 1 by definition. What has happened, and this graph doesn't show this well, is that for the very largest stocks here, the top 100 stocks, they used to have betas that were slightly larger than 1. They now have, on average, a beta that is somewhat below 1. But these stocks are so large, right? I think today, Apple is worth more than all of the Russell 2000 stocks combined, that, Apple alone can offset this increase in betas. So, and we're using here daily betas, but you can plot the same graph using weekly or monthly, and you find similar distortions. Yes.
Sorry to interrupt. Regarding the CAPM betas, you're showing the beta, but what about the R square linked to these betas? Was there any difference there?
So I unfortunately don't have it in this presentation, but if you can basically, so yes, there is an R squared effect as well. The movements so for a stock that has a high benchmarking intensity, the returns of that stocks are better explained by just a market model or a pharma French 3-factor model. And this is not very surprising because, like, for example, a lot of the Russell 2000 not a lot of the money that is benchmarked to the Russell 2000 isn't even in the Russell 2000 blend index, but it is in the growth and value index, and they're very important. And there's actually solid evidence from other researchers that show that basically once you join in Russell, the blend and growth index, your factor exposure to the growth or value factors also increases. So it's not really that these are risk factors. They're more like, I shouldn't go there. Anyway, let's move on. So let me do one thing. What I'm going to do is I multiply the CAPM betas here with a 6% equity risk premium to kind of just convey what the magnitudes are that we're talking about. And as you can see, for the Russell mid-cap stock here in the Russell 2000 or the small caps, these increase in CAPM implied cost of equity are substantial, right? These are like 200 basis points higher. And then what we show in the paper is that this has actually real effects in the sense that firm managers who rely on the CAPM beta to set discount rates will infer a higher cost of equity. And then what we show is in the next fact, basically, that benchmarking intensity negatively correlates with firm investment. So it's like also these firms that have a high beta here that are also the firms that invest less. And these are also the firms that issue less equity. And, you know, so to just summarize our main findings, right? We kind of show in the paper, we spend a lot of time linking this, actually showing what has happened is that these flows have become very important, right? And what really is driving the increase in beta is net inflows into passive mutual funds and ETFs. And in the early 2000s, it seems there was like obviously there was less index investing happening. So these effects were muted. But like especially after 2010, when like passive flows, especially in the US market, are like really a dominant driver, we see that CAPM betas go up. And then how managers react is unfortunately by raising their hurdle rates and reducing investment in CapEx and increasing net payouts. And we show this not only affects firm managers, but also stock analysts and regulators. When I mean regulators, I'm going to be very specific. These are regulators of public utility corporations. Like, for example, in California, this would be PG&E. Because we have kind of written into regulation that regulators in the US and in Europe as well have to use the CAPM when they set the required rate of return for utility companies, which means that if your utility corporation in your where you live is part of a benchmark index, you will likely pay higher utility rates and have a higher electricity bill today, which is a funny coincidence. And I have another paper where I flush this out. This beta effect is actually something that other researchers have also independently discovered. There's a team around Fang et al., I think from INSEAD in Fontainebleau by Paris. And actually there is someone at the ECB pointed out to me that they are also aware of this fact, and this also affects the European market. They have like written in their ECB financial stability review from November of last year. They've actually done a similar exercise to what we do and just correlate show basically that the correlation in the European stock markets also have increased, and especially for stocks that have a lot of passive owners. So I have another 100 slides, so I can keep going, or I'm not sure if there's any questions. If it was unclear, please let me know. I'm happy to provide any details.
Yeah, Christian, I'll jump in.
Yeah.
Thanks so much for this. One of the questions I had shared with you, and I'm looking for it, but it was implied versus, what was the other thing? These betas.
So implied versus perceived cost of capital?
Yes. Can you talk a little bit about that?
So in the paper, we make the argument that, for example, stock analysts, managers, and regulators, right? they use the CAPM to basically figure out what the cost of equity for a stock is. But that doesn't necessarily mean that what they're calculating is the implied or like the true way the market prices the stock. And one way of seeing, where you can see this is basically when a stock joins an index, right? We show that the betas go up, and the betas go actually quite immediate. They jump immediately because the trading happens immediately on reconstitution day. But usually what also happens, right, is a price effect. And if the price is now higher, but the cash flows haven't changed, that means that your cost of capital has decreased. And it also tells you that the market isn't really pricing assets using the capital asset pricing model, that there must be some other factors that determine how the market prices stocks. Because if the beta, right, if the beta goes up by like 0.1 or 0.2, you should see the stock price tank, not increase upon index inclusion. So that's where we say like there's kind of like a mismatch between what the managers, especially the firm managers and stock analysts, what they perceive the cost of capital to be because they use the capital asset pricing model, and what the market actually prices, or how the market actually, forms equilibrium prices. And that is the kind of the difference here. So,
Okay. And what I hear then is the pricing is distorting risk to a certain degree. There's a difference between the pricing and the fundamentals. So a part of me thinks as a value investor, that should create opportunities for active stock pickers. And maybe it would, but if the flows continue, those mispricings may not get realized or may not get realized for a long time. How would you respond to any of those thoughts?
Yeah, I think that's a good point. And I think I agree that there are opportunities for active managers. Although I want to say I've never worked specifically as a portfolio manager, so I think you guys can probably speak much better to this. But you can imagine, for example, like a pairs trade where you find a stock that usually moves very closely on fundamentals with the stock that has just joined the index, which is now moving a lot in response to these flows. And eventually you would think that their prices need to converge at some point. And I think there might be an opportunity for pair trading here on if you find stocks that usually co-move. We haven't really explored this in this paper, but I'm sure that already some people are doing it. So from what my understanding is that a lot of the big hedge funds, especially the pot shops like Millennium, Citadel, and so forth, one of their most valuable or most attractive strategies and their biggest pots are actually doing index arbitraging. And I think just in March, Millennium lost close to $1 billion on index arbitrage, because what they're trying to do is to front run these flows, right? They're very aware, it seems, of this mechanism, and that flows into passive funds have become such a big and important driver of returns in the market.
Well, that doesn't sound promising. That sounds like don't get in the way of the flows, which is a little at odds with. I read Cliff Asness had a piece on this last year at some point, and he was arguing that you're going to see more volatility short term, but longer term, the difference between the flows and the fundamentals should come to fruition. But sounds like we're not seeing that yet.
So yeah, I mean, getting in the way of these, I mean, these flows have become very large, right? And the problem is they're very correlated. So if you want to trade this, you're exposing, and they have become a factor. That is the whole point of the paper. Like these flows used to be more idiosyncratic, but since we're now all kind of noise trading in ETFs, these flows have become more of a factor, and not sure you want to take on factor exposure. There's always the case with like short run and long run. Like in the long run, things should converge, but in the long run, we're also dead. So yeah,
Yes.
I mean, I'm never sure. Like this is just an eerie statement, but I'm not sure what the long run means.
Yeah.
The long run is just like a succession of short run flows. Not sure when these stocks will converge.
Yeah, we're all struggling with this, particularly as fundamental managers. But another thing I pulled out of your piece was cash flow betas remain stable while CAPM betas increase. And to me, that's another illustration of this tug of war, if you will, between fundamentals and flows, or pricing versus the fundamentals.
Yeah. I think like in the current version of the draft we have, so in the old version I think that was initially shared, we were coming kind of out in full force and saying this is a big distortion, this is bad. Since then we have toned down our language a little bit on this. Mostly
Okay.
because like as an academic to say something is a distortion is there's a very high burden of proof that other academics put on you. Because first of all, it's not clear that we used to be in an equilibrium where everything was okay, and now we have moved to something that is worse.
Yeah.
That's not really clear. So what we point out with this divergence between cash flow betas and CAPM betas is we think evidence that these discount rate shocks or like these flow shocks have become more important. Personally, I think this is not great because it's not really fundamental information that gets impounded into prices. And there's some other researchers that show, for example, when the passive ownership share is high, you have the prices in general are less informative, or the level of prices, because there's more post-earnings announcement drift happening, and prices react stronger to earnings announcements, which kind of means that before these prices were not efficient. What we point out is the covariances have changed, and covariance signals are now also affected. Personally, I think this isn't great because we have taught everyone and their grandmother in business school that they should use the CAPM to make investment decisions, at least firm managers. And my takeaway really from this research is that we should stop teaching the CAPM in business school. I mean, it's unfortunately our foundational model, and it is beautiful in its simplicity. However, since it never really described expected returns or realized returns, its empirical content is actually, it's been empirically rejected in almost every market every time it's been tested. So why do we keep teaching it? There's other ways that you can calculate a firm's cost of equity, and I'm sure you're aware, like Gordon Grove style models where you just look at the earnings yield of the company, the cyclically adjusted earnings yield, and you tack on some expected growth and some expected inflation. And maybe that's a better way to calculate your cost of capital rather than CAPM betas in today's market.
Chris?
Yes. Sorry. Yes,
Alex.
Yeah, one question there, because you were mentioning in your paper some alternative ways of measuring betas. And I don't know if you could comment a little bit on this, because somehow given these findings that the implied beta from cash flows did not change, and this idea of the distortion that you were mentioning, somehow it leads us to maybe a problem of how we measure beta, stop using beta from realized markets in order to measure business risk. But these alternative measures, I would like to know whether they were pointing in this direction also, or...
So yeah, that's sorry. Yeah, thank you. I think that's a good question. What we explore several ways in the paper to kind of see if, was it that fundamentals changed? And one way that we do it is basically using, for example, accounting information, right? Just your return on equity from accounting information, and then seeing how your return on equity from the accounting statement co-moves with other firms or with the market developed from this accounting information. And I think that's what Robert said. Like we find here that when we do this exercise, that these betas actually have not changed. They look roughly like they looked like in the early 2000s, and you can do it in different ways. You can also look like, okay, one way that economists would like to do things is like, how much does your return or like your company's cash flow, how much do they move with the aggregate consumption? And there's some theoretical argument why this is especially valuable, but I think I would suggest, like, if you still want to rely on like this co-movement type argument that the CAPM beta kind of embodies, yeah, then you should probably move away from just returns and augment it with like real cash flow growth or some accounting information, or like what I've recently explored a little bit is for companies that have a lot of sales that use credit cards, you can also like back out basically a credit card beta. How much do your company's credit card receipts move with the aggregate credit card receipts? And they look sometimes very different from how the stock market moves. And I think there's alternative ways, and the literature has proposed quite a few ways to adjust the beta. We might do a short write-up in the near term, and then I'll happily share with everyone on what our thinking is and how to adjust it. Yeah.
And regarding the market return ones, the ones that are purely based on market returns, you were mentioning in the paper some statistical adjustments to it, but you didn't manage to somehow remove the effect of this co-movement.
Yeah, so what you can do is like in the paper we have like some simulations, basically where you can basically undo these flows, but it is quite burdensome to do so. You need a lot of data. You need data on the flows. You need to know which index every stock is in. You need to know how much money flows into these indexes, how people trade. This is like computationally a very high burden. So I think one easy thing that you can do is you can shrink betas. If you know the stock that you're looking at is in like in the Russell 2000 or in the S&P 500, and you think it has a pretty high beta, you can shrink it, right? By basically using the beta of stock I, and you say, for example, right?
Yeah, that's basically the common practice on the industry.
Yeah. So yeah, exactly.
Adjusted betas, yeah. Mm-hmm.
Yeah, you can, and there's several cool ways that you can think about it, right? You can shrink it towards the industry average. So because like so let me show you this. Because what we explore in this paper, one thing that we do is we show that if you just run a regression in the cross section and you try to explain betas, you find that industry betas are actually a very good, as you would expect, explanatory variable for betas. But the real problem is, right, is this BMI part here. And that BMI is the second best explanatory variable, even conditional on all these other variables like industry, volume, bid-ask spread, liquidity, size, etc. And I think the rule of thumb that we have is that you should probably shrink them. If you know that the stock is highly benchmarked or is in a lot of passive index portfolios, you might want to shrink the beta towards 1. Similarly, if your stock is not in any indices, right? The kind of the opposite holds true here as well. Like these stocks, the betas, they're too low. You should shrink them towards 1, 2.
Christian, can we kind of linger just a little bit longer on cost of capital? And then I want to shift into some of the economic implications. And you touched on that already, because there was one thing in your paper that said something about benchmarking intensity does not correlate with credit spreads of public utilities. And I was wondering if that were consistent. And to me, it says, if I'm going to look at cost of capital, a credit spread is going to give me more insight on the fundamentals, and then maybe take that credit spread and add, some estimate for a premium, and then there's my cost of equity, rather than looking at CAPM betas. Trying to tie some of the fundamentals and thinking, all right, these fixed income guys might have more insight on the fundamental riskiness of the business.
Yeah, this is an interesting exercise, I think. I think you could do something like this, and I think there are risk models that try to go in that direction. The only thing I would be worried about is that credit investors or fixed income investors, right? They care about very different types of risk than the equity investor. So
Yes.
you care much more about like the real bad downsides where you really actually hit bankruptcy. You actually lose money. So I think I'm more in favor of using dividend yields or equity yields of that company, or like the industry that the company is part of, and then add on some growth expectations, some inflation expectations for that industry, rather than just relying on the credit stuff. So I mean, we've explored this credit stuff a little bit because we try to see if there's this, like you said, if there's any fundamental changes. And we, for example, find that CDS spreads don't move, or that for the public utilities that the approved rate of credit or the credit spreads also don't correlate with benchmarking intensity.
Okay.
Which might just simply be the case because the credit analysts don't use the CAPM beta as much.
Okay, and that touches on, to me, a much larger issue of what is risk. And different investors are going to quantify that differently. They're going to build portfolios differently based upon their perception of risk and/or what they perceive as the greatest risk at the time they're making that decision.
Yeah.
So, and all that stuff, it kind of ties into that. But any other questions at this point? Because I've got a bunch more, but want to open the floor. Anybody else? Not all at once.
Right. No, I think you touched on a very important point there. So what we're not saying that market risk isn't important, and especially I guess for you guys, for portfolio managers and for active investors, this matters a lot, right? This is matters for your performance. It matters for your funds exposure to market risk, and you should definitely take this into account. We're just saying it is not a good way to measure the expected return on a stock. And I think everyone is on the call is probably aware of that, right? If you invest in high beta stocks, it does not mean that you get high returns and expectation. If anything, you will underperform someone who invests in low beta stocks, at least on average in the long run. But like, so these stocks are more risky. The question is just, do you get compensated for taking this risk? And so we've explored this a little bit, and it doesn't seem to be the case that there is higher risk compensation for these stocks. So they're not earning higher returns on average, but they're moving a lot with the market. And that is some type of risk, and it might even be rational for corporate managers to also take this into account, right? You might want to hold more cash on balance sheet because your stock now moves much more with the market, and therefore, if the market goes down, your equity might go down as well, and you might want to rationally insure against this by having more cash on balance sheet. Also, if you remember business school classes, there's the difference between asset beta and equity beta. This will also if you hold more cash on balance sheet, it should also lower your equity beta a little bit. Because now you're somewhat less risky, right? Because you're kind of insured a little bit.
Oh, thank you. Want to get into potential economic implications, but you just touched on something else I have a question about, was the payouts. So companies are doing less investment, right? And they're paying things out. Is that dividends or buybacks?
So from what we see, it seems mostly to be buybacks and not much dividends.
Yeah.
So we kind of in our empirical analysis, we sum them together and just define it as a net payout. Because from an economist's perspective, if you pay out in dividends or in stock buybacks is the same, but I understand that in industry there's a difference. But I think we looked at it separately, and it seems to be mostly in the buybacks.
Okay.
Especially for stocks joining the S&P 500.
Okay, that makes sense to me. Do you know, or did you look at the evolution in that? Like in the early 2000s, maybe it was higher dividend payouts. More recently, it's higher share backs. Is that accurate?
Yeah, no, I think that's the general trend, that everyone has moved towards buybacks and away from dividend distributions because the tax advantage associated with that.
Okay.
I'm not claiming this is related to the increase in passive investing, this shift towards one or the other. I think we just see generally more payouts because the beta is higher. That is our argument. And managers find less projects to invest in.
Okay. And then switching gears, earlier you had mentioned, I think, if I was listening correctly, high BMI. If you have a utility company with high BMI, you're going to pay more in your rates.
Yeah.
So there's a part of me that is thinking we could make a almost not an emotional, but a different kind of plea to investors. Like, don't invest passively because you're going to pay higher rates, and or passive investing is reducing investment. It's reducing economic growth. Is that too much of a stretch?
It that is one. I'm somewhat sympathetic to these arguments because yeah, our papers can be interpreted in this way, but it is not necessarily. It is a convolution of two things, right? It is the passive investing changes betas, and that managers and regulators use betas to make real world decision. So it's like you need both things to be true. And you could argue that really the bad thing is that people use betas, and it's not necessarily the fault of passive investing. But I leave the deciding who the culprit is to you.
Yes. And to be fair, we've talked with a number of academics, and you even mentioned earlier, you're not an analyst, you're not a portfolio manager. And typically what we find with the academics is they'll present the studies, here's what we found, here's the correlations, et cetera, et cetera. What it means, what will leave to the practitioners. So I'll lean on members of the advisory board to say, okay, given this, what would you all do?
As a practitioner, I think, or former practitioner, I definitely think that there is this idea and linked with the previous research that we were covering, this idea of lower diversification effect with these R squares leads you towards that there will be more opportunities on smaller companies and mid companies on average. And now this new idea of these distortions on the beta, which is an old one, leads you definitely to shrinkage and to lean on your fundamentals and not that much on the market, because it is the market the one that you want to beat. And now it was somehow resonating with me with this idea of this huge concentration on the index. And I was looking again at your graph and how these mega caps, they didn't see their beta change by definition because they are such a large part of the index. And I was like, indeed, I was thinking about Robert's idea, and I was like, oh, damn, these mega caps again, they are winners in this environment because their beta is not going up. It's incredible. And it is by construction again, because the beta of the mid caps getting similar to the beta of the mega caps means that this one is going up. But so I don't know if I don't know if I add something, but I was again looking at these mega caps points there, and it was like, oh my God, they are winning this game again.
Yeah, I think this is a very good point, Alex. They're benefiting from this trend, right? And so their betas are now lower than 1. We don't find that they respond much to this. It's not that, at least, I mean, now the mega caps are all investing in AI, but like in the 2010s, they were not really responding to this subsidy that they got. But there is.
Chris, but if you are 40% of the benchmark, your beta is going to be 1, no matter your business risk. So
yeah,
again, we have the same problem.
Yeah,
again,
which is kind of funny, right? Because like I think the original formulation of the CAPM doesn't really have that notion of big differences in size. So yeah, if now, like, the Magnificent Seven are, I don't know, what, how much of the stock market are they? That's insane, like 70% of the US now. Yeah, the betas are going to be one. They are going to be the market. But does this tell you much about how the fundamentals of these companies are evolving and what their cost of capital really is relative to their fundamentals? Not so sure.
Yeah. That's one of the key themes that I'm hearing again, this price versus fundamental. And you may be right as a fundamental investor and find really attractive companies, but if the flows continue, you may not be recognized for a while. And to Alex's point, the surge in betas among kind of the mid cap companies, that's really interesting too. Hadn't thought about that.
Yeah, and right. These are also the mid and small cap companies are that's where we've seen a lot of exit happening as well, from at least in the US stock market. We're thinking about exploring this in a follow-up paper, kind of like what is the role of the passive and the beta in the shrinking universe of public firms and the rise of private alternatives. I think they're very interesting feedback effects because it also means, right, we haven't stopped putting money into the market, but now there are less companies to invest in, which mechanically raises for any company, raises their benchmarking intensity. And I think this has like kind of a lot to do with this increase that we've just like eliminated many companies in the universe of investable stocks in the US. And it's a very interesting feedback effect, right? If you think that now you're exposed to a lot more volatility as a manager, or like if you might consider like, hey, should we orchestrate a takedown of this company to private markets where we're not exposed to this these fluctuations that purely come from the stock market being thrown around by these large flows. But yeah, this is more speculative. We haven't looked into this in detail.
Do you want to speculate on that a little bit? Because I think that was one of the questions that I had for you. And I did a little research on that Gutierrez and Philippon paper, and maybe you can talk about that as well. But I know they're looking at competition and increased concentration. And there was something in their paper about increasing concentration, or concentration was decreasing when there was high IPO levels in the early 90s. And I was thinking, and you kind of alluded to this, the increase in private equity investing, maybe that's exacerbating this. So you've got an increase in private equity. We're taking public companies out of the market, and the ones that are left, you've got this increase in passive. So you're going to have increase in CAPM betas, and if Gutierrez and Philippon are right, you're going to have less competition and greater concentration. I mean, this is just a really tough environment then for active managers.
Yeah. So I think the Gutierrez Philippon story is very interesting. Let me just maybe give some color on what this actually is. Sorry, I have many slides, as I said.
I was going to say, whoa, you're prepared.
So what their story basically is, this Gutierrez and Philippon story, is that is the story about missing investment. And missing investment kind of describes the fact that in the US, I think particularly in the US, investment in real assets has been relatively low relative to valuations. And that is kind of like Tobin's Q here. What that really measures is market value. Sorry, that's not legible. Market value over book value. And when the market value is high, you should invest more as a manager, because if the market tells you you're a very valuable company, you should invest more. And somewhat in the early 2000s, and usually this works pretty well when we like run econometric tests of this, we've usually found like, hey, this theory works pretty well. When market valuations relative to book value are high, managers invest more. This kind of breaks down in the 2000s, this relationship. And then there have been several explanations for this. And I think the two biggest explanations that people come up with is that it has to do something with competition, maybe. There's now less competition in many industries than there was maybe 20, 30 years ago. And if there's less competition, then you need to also invest less, and you have like all these monopolistic rents that accrue to you. And you're gonna so that will drive up the market value, but won't incentivize you to invest. Another, I guess, fruitful explanation that people have explored is that maybe we just have become really bad at measuring how firms invest, because now there's all these intangibles, right? They usually are expensed on balance instead of like being accrued on balance sheet. And maybe that can resolve the puzzle. And both these things help to kind of narrow the missing investment puzzle. But even accounting for a lot of it, like there's some methodology here that won't go into the details. But basically, even if you account for these two mega trends of like rising intangible share and a decrease in competition, you still find that roughly 20 to 25% of investment is missing. We should have 20% more capital and seen 20% more capital investment in total, standing in 2019. And what we argue is, well, if managers think the discount rate is different from what the market actually prices, if managers, when they do capital calculation or capital budgeting, when they decide to only take on projects whose return on equity or where the WACC is over a hurdle rate of, let's say, 10%, but the market actually only prices a hurdle rate of 5%, then you will also see that the manager relative to the market underinvests. And then when we do this calculation, what comes out is basically the change in the weighted average cost of capital that caused by the beta increases can close this gap here by roughly 50%. So we can't explain everything, but we can explain roughly half the gap if you believe that managers' discount rate is different from what the market actually prices.
Got it. Yes, that was that 57% figure in the paper, correct?
Exactly.
Yeah, okay.
Yep.
This really helps. I was missing that as I was reading through that. Thank you. And yeah, you touched on something that also comes to mind, that kind of winner take all business model approach. So again, if I hear you correctly, if I'm in a winner take all industry and I'm the winner, my competition has gone down. There's fewer public companies. More companies are staying private longer. I don't have to invest that much. I'm the king of the hill, and I'm not getting pushed off the top of the hill. I don't have to invest. You know, I hear that as well.
Yeah, so it depends on a little bit of, you said like, well, favorite answer of any academic, it depends. So it depends a little bit on what you think the industry structure is, and you know, I'm not sure how much it features in the like, because you like the public-private disconnect features in, because you still have to compete with a private company, even if you're a public company.
Yes, yes.
So, yeah, but I think these are great questions. We don't explore in detail this competition angle, but you know, it's other than saying, well, you can imagine a thought experiment where there's two companies in an industry one is public and joins in like is in an index, another company is not in the S&P in whatever index. Therefore, they have different betas, even though really their fundamentals would probably imply that they have very similar betas. But like you see now that one company, if managers actually use the CAPM, will make very different investment decisions.
Yeah.
We explored this a little bit in one of the appendices that we have, and it seems to be the case that in industries that have greater beta dispersion because of benchmarking, where it is actually happening that there's some companies are highly benchmarked, other or like highly in passive portfolios, and others are not. These are also industries where we see a lot of dispersion in investment and in
Okay.
yeah. So we explored a little bit, but I think we can do actually more on this. I think this is a very interesting avenue to explore, but yeah.
Okay.
Paper is already close to 200 or 120 pages or something.
I can see that given all the slides that you prepared.
Yeah.
But
Yeah.
on that line, before I lose my train of thought, because there's another line that you had, and Christian, I'm using an older version of
Yeah,
the
no worries, no worries.
the one that you submitted, kind of went back and looked at
Yeah.
that. Where in that one you said all else equal, a firm inside a benchmark index invests less than the same firm outside the index. So if that's true, have you looked at any economic implications of that? Like, is there a tie to GDP? And that's why earlier I was kind of making this almost emotional argument, like, look, don't put your money in an index because the firms in the index are investing less. They're not going to generate new products or services. They're not going to increase shareholder value. The economy is going to shrink, blah, 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 blah.
Yeah. That's a very good point. And we explored it a little bit. So I have industry results somewhere. So here, industry results. So basically what we can do to address this somewhat is what we look at taking the difference between taking a long time series view, where we compare industries development over the past 25 years, where we basically see some industries have seen a lot of increase in benchmark linked investing or passive investing, and other industries have seen less of this because they're, for example, more private companies in an industry, or just differences in exposure to benchmarking, even if they are public companies. And when we just look at which industries have a lot of big changes in their benchmarking intensity, this would be the industries down here, and compare them to the industries that have seen little increases in their benchmarking intensity, we find that industries that have seen big increases also accumulated less capital. And now this is at the industry level rather than an individual firm. So naturally, this will have aggregate effects. And these effects are very strong, actually, and like we were kind of surprised by this. So it seems that there are effects at the aggregate level on GDP, and then eventually also on consumption, because I mean, in the end, it means we have invested less. In equilibrium, we might consume in the short run a little bit more because now we have more capital, more money that we can consume. But like in the long run, this means our production possibilities are lower. So in the long run, if we keep not investing, this is not going to go well. Is it clear, or I can go on about this?
No, that's great. That's great. I know I've been asking a ton of questions. I want to make sure. Any other questions for Christian? All this is terrific stuff, and it seems like maybe we're giving you some ideas for additional research as well. We don't want you to get bored. Rachel, anything? Maxime, Rhonda, Alex, Grant? Okay, everybody's staying pretty quiet. But Christian, let's switch it around just a little bit. If I'm a passive index provider,
Mhm.
okay, Rachel, thanks very much. Just saw your note. All good. If I'm a passive index provider, should I change anything? I thought there was something in the paper that said, like you looked at the equal weighted index versus the cap weighted index. You know, should I be promoting more of a cap weighted index to minimize some of these distortions and their potential consequences?
So, yeah, I think that's a good question. And when we did some writes down some mathematical model that we solve, and like what comes out of this model is that if we would all use one index, and this index would be the actual market index. So, for example, the crisp value weighted index to benchmark and to use for the passive funds, the betas would not be distorted. So what really is the key here that we see these especially these distortions in the shape that the small cap firms and the mid cap firms have the highest beta now. What really drives these, sorry, going through all these slides here. What really drives this shape here is the fact that we have heterogeneity in benchmarks and that there's more capital relatively speaking here in the Russell 2000 companies. So they're getting moved around more when there are flows. But if we would all just agree that all the passive investing guys should just really hold the market and be really passive instead of making a choice, oh, I'm gonna buy the Russell 2000 and I'm gonna buy the other. But everybody would just be really passive and just hold the market portfolio in the passive funds, then betas would be fine, actually, because this is exactly what the CAPM tells you kind of to do. So it is, I'm not sure about like the equal weighted index and if that helps. I haven't explored this in detail, but what I can say is it is the heterogeneity in indexing that is creating these interesting shape in the beta distribution.
Okay. And on that front, can you go back and maybe revisit the BMI?
Mm-hmm.
Is that looking at specific indexes?
So yeah, what this BMI measure does is I have a slide for that somewhere.
I'm not surprised.
Yeah, this is the 10. Yeah, there it is. So what BMI measures is it basically looks at, I think, over the 30 big indices that are in the US markets. So like S&P, mid cap, S&P 500, etc., all the Russell indices and the sub indices of the Russell. And it looks for every stock I if it is in the index K. And then what we basically calculate is how much money is tracking each index. So how much mutual fund and ETFs are benchmarked to a certain index, and what is the total market cap of that index.
Yep.
So, and then what it just tells you is like what is the stock's ownership share just because it is in an index.
Yeah.
Which is like, if everyone is passive, this is just a passive ownership share because the stock is in an index. But like, there's some more nuances to it where we also take into account that active managers often hack an index, right? Because you want to minimize the tracking error relative to your benchmark. and they would also be in here. And it covers around 90% of mutual fund and ETF assets.
Okay. Okay. Yeah, I thought this was a great measure because it's not just the inclusion in the index. When you're looking at AUM, then it's the flows. You're
Exactly.
accounting for
Yeah,
the flows.
I
So
should point out this is great work that has been. This is not our work to come up with this index, but Anna Pavlova from the London Business School
okay.
and Taisia Sikorskaya, who's at Chicago booth, that came up with this. And as you rightfully point out, right, a lot of people have studied these index inclusion events here,
Yep.
but what really matters, and they point this out, is like how much money is actually tracking an index.
Right.
Because you can think of there's so many indices, that no one is following, no one is benchmarked to these indices. There's no product. So these indices don't matter. What really matters is the capitalization weighted usage of these indices.
Yeah. And then if I also hear you correctly, it's if everybody could agree on one index
Mm.
and the CAPM betas wouldn't be distorted, but because you've got this almost gold rush into benchmarking, the assets that are tied to a benchmark, and it sounds like they're capturing 30 of them are skewing it. So
yeah, and then it becomes a question why you're using certain indices over others to benchmark or like for your index product, right? And a lot of it is just because retail investors know the S&P 500, right? So if you use the brand name S&P 500, I'm sure you're aware you have to pay to use this brand name. And actually they charge very high fees that you can use this brand name.
Yeah.
So it's really just a lot about, it's like about brand recognition that retail customers have when they make people like in index funds use and ETFs use this brand recognition. And it kind of already tells you this is not fundamental investing anymore if we're just following brands now.
yeah, the behavioral elements of affect, right? And when
Yep.
I want to have this index, but not that index. Okay, we got about 10 or 15 minutes to go. Any other questions? And if not, I'm going to ask Christian to make some final comments. You kind of hit this at the beginning,
One
but if you can
question here.
summarize. Oh, Alex, sorry.
So regarding this last topic on the heterogeneity of different indexes tracking and how this is behind the distortion of the betas, is it really because of different indexes, or maybe because each of these indices uses different replication techniques, and this produces that somehow they are kind of some of them for these Russell 2000 companies, they are using 300 of them because none of them uses the 2000 because, or many of the mid-cap indices, they do not use the 2000 because it's too expensive for them and they are producing these co-movements. So it's a technicality, but I didn't really understand why the heterogeneity, if they are all using, let's say, the same algorithm and the same technique, then at the end of the road, it would be one and only big portfolio. So it has to be some kind of a noise coming from replication of the indices or something.
So I think that factors in a little bit, and I think where you can see this is that this isn't perfect, right? This is kind of almost like perfectly here. So you're absolutely right. People, especially ETFs, right? They use sampling techniques to track the index. They're not, and often what they exclude are the smallest stocks because they receive the smallest weights, so they have the least effect on the tracking error. That's I think why we see that the beta slopes down for these guys earlier than what the benchmarking intensity would imply. So I think sampling definitely plays a role in the replication of these indices. But what what our model tells us is that what really matters are the flows at the index level. And if going back to what we discussed a little bit earlier, if we had only one index and that index that we were all tracking was the market index, then then any inflow would be proportional to the weights that a stock has in the aggregate market. And these distortions that like stocks here in the Russell 2000s have like much higher betas would not be true. They're only true that because there is a lot of capital tracking these indices, and they kind of create a pocket of covariance, basically saying that these stocks have become highly correlated because they all move together in response to flows. And they move less so than more so than like these guys move. And it is really the segmentation that different indices create, and like pockets of covariances in the market. And
So these
basically
pockets are
we've
created
segmented
because
the market too much.
and somebody's selling the S&P and going for the Russell 2000 value or the Russell 2000 growth, and then there is this co-movement there.
Say that again? Sorry.
If a very large, let's say, passive manager, passive in terms of selection, decides to move from the S&P towards the Russell 2000 value, for instance, then there could be this distortion on these mid caps or something like that.
So yeah, I mean, yeah, it's interesting. So like, if you think it through, right, like they would first trade out of the S&P 500 stocks at the same time. So that creates a covariance in that block. And then they go and buy all the S&P, the 2000 stocks at the same time, which creates now a covariance in this block. And because you create the covariances in this block, it also kind of means that it creates like a negative covariance, or like a negative, I'm not sure, a negative or weakly negative covariance with the other stocks. Especially, right, you now sold the S&P 500, so you're like creating downward pressure here and upward pressure in the
mid caps.
In the mid caps. And really what the beta is just like, it's a summary statistics of a pairwise correlations in the market. And you just, if you trade these big blocks of the covariance matrix, you're just going to create more higher pairwise correlation among these ones, and you probably reduce them with other stocks. And then this creates just this segmentation in the covariance matrix. And it happens the case that these flows are also correlated with market returns, which gives it another kick.
Thank you, Chris.
Yeah, you're welcome. These are all great questions. Thank you.
Christian, thank you so much for joining us. To wrap up, key points that you'd want to stress about your paper.
I have a slide for that. Oh, wait. Yeah, I mean, I just want to. Sorry. So many slides.
We can tell you've been busy.
Yeah. So this is going to be my what is called the job market paper, the paper that basically is my dissertation that I then go present at other universities, and hopefully they will hire me. So I need to have all my T's crossed and my I dots. So that's why I have all the slides. Yeah, I just want to kind of summary of my findings, and I think this is the key takeaway is that benchmark-linked capital flows have become a first-order determinant of beta. And this is, I think, the key insight that you, as a manager, analyst, portfolio manager, you really have to think through basically every position. How exposed am I to capital flows in and out of passive indices? Because that really, these have become so large that they will affect the whole market, and therefore they affect CAPM betas. This is just one. The CAPM beta is just a manifestation of these flows, and I think, given that we've only seen an increase in this in passive, this is not going to go away for a while. So I think we're like really in a new equilibrium where we need to be aware that these flows are going to be there and they're going to be important. And I think these other two papers here, especially the Fang paper, makes like a very interesting point with that they show like that in 2009, during the financial crisis, these passive flows actually contributed to a lot of market risk, because there was this mechanical trading out of these passive funds that amplified volatilities in the market. And I want to thank you for your attention and all the great questions that I got. And if you have any questions, feel free to reach out. I'm also happy to share any of the material if you're interested. And I want to thank Robert for organizing this and giving me the opportunity to also learn from your questions. Thank you.
Of course, very, very much a two-way street. And yeah, Christian, we'll definitely be in touch. You know, I'd like to write this up into a summary, post it on the website, and just, if nothing else, share your research with the world and get folks to think about it and ask some of the key questions, because the answers may be different for each investor, but at least the questions hopefully make them better prepared to make good, thoughtful investment decisions. That's what we're trying to do. All right.
Yeah.
With that, we will wrap it up. And Christian, say thank you once again. Good luck with your studies. Keep up the great work, and we'll be in touch, my friend.
Thank you so much. You have a good day.
Thank you, Christian.
Take care.